Before I say anything, I'm not your CPA. So please consult with a professional financial advisor and a CPA when it comes to taxes. I always get asked, what should I focus on when making a real estate investment decision? Is it the returns? How about the economy? What about inflation? What about the interest rate? But often, many of these savvy investors overlook the tax advantages that comes along with real estate investing. I mean, who likes to pay taxes? I don't. It's actually one of the reasons I started InvestStream, after paying tons of taxes over my W-2 career. The biggest thing in a real estate investment is leveraging depreciation. Basically, any structure that is already built, you can depreciate either over 27 and a half years for residential buildings or 39 and a half years for commercial buildings. What this does is you can depreciate the entire asset value over the life of that value. Depreciation acts as a non-cash expense, reducing your net operating income and therefore your taxes. What's even more beautiful is what is called accelerated depreciation, where you can accelerate that 27 and a half years or 39 and a half years into the first year on all the mechanical and non-building items within the first year of your investment. That can be, in certain scenarios, 100% of your investment within 1 year. Think about that. So anything in the building that can be removed, you can depreciate in year 1. The list is massive. Doors, windows, HVAC, fixtures, all of that you can depreciate in year 1. So what we do, we bring a cost segregation engineering firm that kind of divides our value between the actual brick and mortar and everything that goes inside the building. And by doing that, it allows us to depreciate all the removable fixtures and mechanical systems and depreciate all that in 1 year. That's massive. And we continue to depreciate the structure over the lifespan of that building. If an investor invests 100K, by the end of year 1, they will get a paper loss in a K1 of a similar amount. They can use that to offset any capital gain they have that year. If you've been watching the news lately, the one big beautiful bill has passed, and many didn't like most of the provisions, but as real estate investors, we love it because they reinstated permanently 100% of accelerated depreciation on all of real estate investment, and that is huge. So what does it mean for you? All you need to do is look for passive or active investment opportunities of commercial real estate buildings. You got that K1 in year 1. It says negative 100,000. What are you gonna do with it? First, you can offset that year capital gain. You may have sold a business, your home, some stocks you kept for a long time, and now you're getting hit with capital gain taxes. If that was the year, you can just grab that offset and pay less taxes. The other way you can use that benefit is you can roll over that negative K1 to a future year where you and your CPA have planned that you're gonna have a big capital gain and use it later. You can even use it within your same real estate investment by continuing to roll over that negative K1 until the end of the project where you're making that big check. As a real estate investor, the one thing I'm not gonna tell you, like everybody else does, that you can offset your W-2. You cannot offset your 1099. You can only offset capital gain. So make sure you understand that going into investments. So we already talked about depreciation being one of the biggest deductions you can enjoy in a real estate investment. But there are other real deductions in a real estate investment. There's the operating expenses when it comes to payroll, management fees, utility bills, taxes, insurance, what have you. But the other big one that is as big as the deduction on depreciation is the mortgage interest. So whatever loan you take to leverage your investment, you can deduct the interest from your net operating income. That mortgage interest will reduce your net income, which therefore reduce your tax liability. So we talked about deductions and depreciation and how it's going to actually lower your net income that will be applicable to tax. But all of that in real estate gets applied to capital gain tax bracket. It's not your ordinary income tax bracket. What's beautiful about the capital gain tax brackets, as a family, if you make capital gains less than $96,000 in the year 2025, you pay zero taxes on that capital gain. Now, anything from $96,000 to $600,000 capital gain, you pay 15%. And anything above $600,000 for that year, you pay only 20%. But wait, it gets better. If you or your spouse can earn the special status of the IRS that is called real estate professional, things open up even further. If one of the spouses have that status, the IRS considers the entire income of the family, even if it had W-2, 1099 in the mix, as passive income, which is huge. You can only use a 15% or 20% tax bracket on the entire income. 1031 is quite simple. Say you bought a shopping center for $1 million. A few years later, you sell it for $1.5 million. Now you're gonna pay taxes on that capital gain. But if you identify another commercial real estate property within 45 days and close on it within 6 months, you can actually defer that capital gain taxes to a later day, which is huge. And you can do that over the years, from one building into a bigger one, into a bigger one, as you progress into your real estate investing journey. Another area we always look at, especially in the inner city limits, is opportunity zones. Often allows you to actually not pay capital gains on that development down the road. On our ground up development, we focus also on, can we get some tax credits or grants from the county or the MUD district? This helps reduce our construction costs significantly and allows us to make a project that maybe didn't work on paper to actually work, and we proceed on the execution. We told you all about the real estate tax benefits, but did you know there are many other tax benefits that you probably didn't hear about? First is the health saving account. It's the only triple tax advantage account that you can leverage. Your contributions are pre-tax, your growth is pre-tax, and for qualified medical expenses, your withdrawals are also tax-free. If you're a business owner, there's Section 179. In certain scenarios, you can deduct your equipment, heavy machinery, certain vehicles, and off-the-shelf software in the year that you have made the purchase. Similar to the health saving account, there's something for tuition for your children. It's called a 529 plan, where you can lock in today's tuition into the future, or you can have some savings pre-tax for your future children's tuition. Another one, if you're a business owner and you have a pass-through entity, you're actually qualified per the new tax code to deduct up to 20% of that income. This is called QBI, or Qualified Business Income. I know I threw a lot at you with all these nuggets and tricks of how you can save on your taxes. I know it's confusing. I was one of you. This is how I started my journey in real estate and started to learn about these tax codes and how to save taxes after a long career in W-2 where I paid a lot of taxes. Consult with your CPA. Start tax planning with them. When are you anticipating these gains from your different investments? What about the losses? Are they real losses or paper losses that we talked about from real estate or other businesses? And how can you combine all of that in a multi-year plan that allows you to optimize your tax exposure and pay the minimum amount required? If you're interested to see how we bake these tax strategies into our investment opportunities, check out our webinar on YouTube where we interviewed our CPA and we went through all these topics together. For more valuable insights, check out our YouTube channel where we have a monthly webinar recording and multiple other investment tips, and also check out our social media.